Welcome to the ALX Show, where we talk faith, family, and all things real estate. Let's get to it. Hello, and welcome back to the ALX Show. Today, I have Patrick Dunne, who is our resident analyst in all things investment analysis with ALX Real Estate. And today, we're going to be talking about Silverton Capital, which is a new private lending offering from the ALX team. And so, Patrick, I'd love to hear from you some of the broader trends that you've seen in the market, real estate market, maybe economic data you've seen or, housing data, and why what you're seeing, this made sense, if I can put it like that. Like tell me a little bit about Silverton Capital and why this fits in where we are in the real estate market today.
Yeah, absolutely. We kind of took a step back after, all of us, Josh and Shane, Christian, and myself, have kind of been in and around the real estate world for a long time now, and have done a lot of different things in that world. And so we kind of took a step back and said, hey, after having been doing this for 15 plus years, what are the things that we really think that we're good at? And the common consensus was, I think we really know Dallas-Fort Worth real estate. We really have a good understanding of residential real estate in general. We've kind of all had in different ways our hands in that world and been a part of it for since we all really began in our careers. And so number two. Number three is where do we feel most comfortable as a group? Is it as owning and sponsoring deals, or providing capital, or providing a service outside of just putting deals together, that type of thing? And where we landed on, we do love sponsoring deals, but we also really enjoy the capital side and providing capital. And so we started to brainstorm and said, we know so much of this world beyond the last 6 years has been really multifamily focused. And we said, we've got a wealth of knowledge in residential real estate that extends beyond apartments. So how can we best use that? And so the idea came about of, we've, all of us have, Josh and Shane have flipped a bunch of homes. Christian had flipped homes. Josh and Shane have developed homes from ground up. When I was in my banking days, I was kind of a part of lending to all of those different types of investors too. So it just was kind of a natural thing that made sense for us to step into. And, one of our core strengths is just, I think, relational ability to have, and that lends itself well to raising money, I think. And so to be able to put together, identify good deals, put them together in a lot more than what we can just break off as ALX Real Estate, the private lending kind of stuck out as, hey, this would probably be a good avenue for you guys to expand into.
Okay, that makes perfect sense. Well, I'm wondering, were there market signals that were talking to you, or I guess the broader question is, what's kind of like your hot take on the market right now as you see it, and then how does maybe Silverton, I guess, accomplish that, or this is a terrible word, but kind of exploit those factors, if that makes sense. It's not the right word, but before we get into some of the more details of how Silverton processes those loans and all.
Absolutely. I mean, gosh, so the market broadly, I mean, just like the last time we talked, there really hasn't been much change. Everything is still really at a standstill. High interest rates have kind of handicapped everybody, and everyone's really just waiting for some kind of relief. And so with multifamily, it's just a long term between you close on a deal and you'll take an acquisition fee, which is not a big amount. It really just covers your cost of, 6, 8, 10 months of doing work to get the deal closed. So you take that fee, and then in normal times, you would normally operate that property, and once you got it stabilized and are exceeding your NOI targets, there was probably some cash flow left over after paying investors for you to enjoy a little bit of cash flow on these properties. But interest rates just took that piece of it away. So you've got from acquisition to close for you as a sponsorship group to really earn any other revenue after you take on a property. So what, we had planned on being, 3-ish year hold period is getting pushed out further and further in, 5 years and maybe some beyond that. So it's just a really long life cycle to generate revenue, and you can double down on that and you can continue to buy property and just keep building a really big portfolio, and knowing that down the road, you're going to have a big payoff when all of those start to sell. And that's really the direction that a lot of groups have doubled down on and said that they want to do. I don't think that we are necessarily as passionate about multifamily itself as we are about the whole spectrum of residential real estate. And that's probably because of the background that we've all got. So the quicker turn in putting out capital to other investors who are buying primarily residential properties to renovate and relist and sell is a much quicker turn and starts to generate, more constant activity and action. And I think that's a really nice complement to a buy and hold where a lot of it's defensive and just, working asset management and waiting for the right time to sell. Whereas what we'll be doing with the private lending will be a lot more active and engaging. And so we thought that was a real nice compliment.
Cool. Great. Well, tell us a little bit more about Silverton. I guess some of maybe the specifics of the loans that you guys are offering, or how, like if I'm an investor or if I'm needing to get that money, what does that look like? What does that tell me a little bit about that process? Who's a good fit? Who's maybe not a good fit? Anything like that comes to mind?
Absolutely. So I'll preface all of this in saying we are not like, I think I've said this every time that we talk, we're not like innovative geniuses. Like there are plenty of other groups who do this and do it well. And there's just a great opportunity because it's just the housing market is so large. So we I already forgot your original question.
What are some of the loan terms or tell me a little bit more about the details of what this looks like. Yeah.
Right. So the traditional private lending to residential investor world would really comprise 3 buckets of loans. The first one is what everyone would think of when they think of private lending, which is what you would call like a fix and flip loan. So somebody wants to go flip a house, sees a good investment opportunity to come to a private lender like Silverton and are able to close on the property, have a budget to renovate, fix it. And then when they're done, relist it at the higher price, sell, that kind of thing. That's bucket 1. Bucket 2 would be similar in terms of loan structure, but it would just be to ground up construction. So that's another niche that is, kind of plays to ALX. Before we were buying apartments, what we were doing was ground up development. And so that was primarily townhomes and condo units, but construction is construction in the residential world. And so the builder relationship that we have there, kind of already established, make us, a nice resource for someone who wants to build a residence from the ground up. And then the third bucket would be just a loan to a classic investor wanting to buy a rental property. That one we will not initially target. There's some complications with how we're going to kind of structure everything and all of that, and their longer term holds versus the other two being generally shorter term, quicker in nature. And so, but those would be the three bucket. All of them loan wide will look pretty similar, and there's a lot of advantages, I think, to using a private lender for these types of investments rather than going to a more traditional financing source.
What are those advantages? I'm curious now.
Brandon, I'm so glad you asked. What is really important and most of what I'll say, we're kind of broadly speaking about residential flips.
Okay.
But there are a few things that are really important to folks who are going to buy, renovate, and sell quickly. One of them is quick closing ability. The private lenders have the ability, since you're not, regulated like a commercial bank, to close a lot more quickly than a traditional bank would be able to do. So many times these investors will get their leads from a wholesaler or a ton of direct marketing. Just you get those mailers that you probably get them for your house too, and you disregard and think that they're trash or whatever. But those are actually fairly effective, and the people that they're designed to hit are the people who have a time crunch. So you've had a death in the family and you're trying to sell an old house, and everyone just wants the estate to be done and closed, and that kind of stuff. So oftentimes the closes need to be really quick. So a private lender can accomplish that a lot quicker than a commercial bank having to go to a committee and all of that kind of stuff. The second advantage is you get more leverage generally than a traditional bank would give you.
Okay.
So especially for folks who are starting out and this is their first or second or third home to flip, you don't normally have just, millions of dollars on hand to go and put into a property or invest in. You're normally starting on a small scale. And so the very risk appropriately, the least amount of money that you need to put, that you have to put in up front is beneficial to you. If you've got $100,000 of life savings and 50,000 of it is going to go into this, then, that's a lot easier to stomach than a bank saying you need to put in 100,000. So there is a great leverage opportunity. And then I think, and what we're really excited about is that because we've all done this and been on the side of who will be our borrowers, we're hopeful that there's real relational movement there, that we can be more than just someone who's giving them a loan, but we can be a resource. We can, talk through budget, work through overages, and help be a resource for contractors and with all the folks that we've worked with in the past, and hopefully be someone that people want to go to when they need to, or when they've got an investment opportunity that seems attractive to them.
That kind of gets at my next question. I'm just sort of curious, what is something that you are really hopeful for with Silverton in this new venture with private lending? Like, what's something that, if this is successful, you're like, yes, we did it. We accomplished our goal. Like, what's something like that that you're really looking forward to over the next, let's say, 6 to 12 months?
Well, would love to build it into a really great debt fund. I mean, that's the primary objective. And what I think is exciting too is that it's going to be a little bit of a different offering to our investor group. And I think it's something that they're really going to enjoy. So, on our multifamily properties, our structure is really simple. If you're an investor coming to us, we've got a preferred return that we pay and do our best to pay it in its entirety. There's no complicated waterfall after that. We want to keep it as simple as possible. Preferred return. Then when we go to sell, investors get a percentage of the the profit, and try and hit our IRR returns, and that's it.
Cool.
So this one will be a little bit different, both in how we structure the returns and in the investor security in the properties that we're lending on. So the biggest change from apartments is that if someone's investing in Silverton Capital, everything they invest in will be secured by a first lien on the properties that we're lending on. So it is much more secure than a traditional common equity position in an apartment that, a group goes and buys. So downside risk is you've got that underlying asset and you are the one holding priority and not going to get wiped out if that were to happen.
This is on a single family, if I'm understanding. Yeah, cool.
Right. Yes. And then otherwise, it is just a straight interest payment. It still, structured as a preferred return. It is really, it's just we're lending out money at X, paying it out in Y, and there's a narrow spread that Silverton, will keep to, fund operation. But it's a neat vehicle, I think, for an investor because the yield on it is much higher than the preferred return in an apartment investment. So probably 9 or 10% paid out, annually to an investor for a, first lien secure position, which I think is really nice.
That's cool. Okay. That sounds really nice. I mean, especially in some markets, that can be really, I'll take 10%. Sounds wonderful. That's cool. Great. This is a little bit off topic, but I'm just curious. This is something I talked about with Josh weeks ago when it was making the headlines, but do you have any comment or any maybe fallout or things that you're watching with the National Association of Realtors settlement that happened some months ago, or any kind of like change in how you see any kind of real estate deals taking place, or is that not your purview, or do you see anything like that might be interesting to some of our listeners?
Josh is definitely much more plugged in on that than I am. Okay. My perspective has been just kind of let's watch it play out and see what happens and see if there's, significant movement or not. I don't, from what I've heard, and I haven't talked to a ton of people about it, I don't think there's been a huge change yet.
Okay.
Of course that could, still be coming or could happen. So, I'm not quite sure, but yeah, Josh is all over that stuff.
Okay.
And, everything, I like to at least think about it like all my stuff just like kind of starts and ends in a spreadsheet.
Okay. I like how you're saying that. Okay. So it doesn't impact the spreadsheet much, but I'm wondering, is there anything that does impact your spreadsheet right now that you're really paying attention to that is, let's say, pretty fresh, that not many people really are talking about, or you feel like some of our listeners would just, man, if I could tell them this is the one thing that I'm really paying attention to over the next, let's say, 30, 60, 90 days or so. That's really important.
Well, I mean, gosh, I think macroeconomically, I the same question that everyone's got is when will we finally have when will the Fed have what they need to make a rate cut?
Mm-hmm.
And there's obviously everyone's got an opinion about that and opinion about whether or not what the Fed is data they're interpreting is they're making the right interpretation or not, and all of that. But uh, I think that is the timing of that is really crucial because it's getting harder to think that there's going to be some sort of a soft landing if we don't, or the longer that rates, stay elevated. And so then the big question is, what happens if there is some kind of recession? What would be the depth of the severity, and how would that impact, um, people wanting to sell their homes or people wanting to buy their homes, or investment opportunities for someone trying to flip a home, or all of that. So kind of just play through the different ways that could play out, and you can probably spin it really any way you like.
Yeah.
But I think over the last year and a half or so, what interest rates, even here at GFW, reduced home prices, not substantially by any means, but they did kind of peak and hit their trough and come down, and are back on the up again. I was just looking earlier today at A&M's Real Estate Center, and in DFW, the median home price is back up to like 407,000 through April of this year. And, at the peak in mid 2022, that was probably around 430,000.
Oh, okay.
When everything was flying and, everyone was like, this doesn't make sense. When it was those kind of home price numbers.
Yeah, right when I bought my home, you mean, Patrick? Right?
Yeah.
Cool. Okay. But everybody's basically just waiting on a dam to break one way or another. Either they're going to cut rates, or they're going to keep pushing them a little higher. But I think I saw general consensus is market's pricing in about 2 rate cuts this year, maybe, but it could go up as well if inflation isn't cooling, or if jobs data keeps coming out real strong, right?
Right. And what will be even more interesting for, all of us as homeowners or people in the residential real estate world is when rates do get cut, what's going to happen to mortgage rates? So right now, the yield curve is, if you would allow me to nerd real quick.
No, please. This is your place. Yes, go.
Yeah, the yield curve is inverting. So short-term yields are higher than long-term yield. And what will happen is when the Fed eventually cuts rate, there will be a normalizing of that curve where everything will go back into its right order. Short-term rates will be less than long-term rates. We know that that'll happen eventually. What we don't know is what that'll do to long-term rate, over the first year or so after that happens. So it's kind of a wild card thing. And what I mean is, the Fed funds rate right now is 525 to 550, and the 10-year Treasury, I think, was just under 450 today. So there's about 75 basis point difference between those two. So when the Fed starts to cut rates, or cut their Fed funds rate, and that will make the short end of the Treasury yields start to fall too. 6-month, 2-year, all those that are higher up right now too. But what it doesn't necessarily mean is that the 10-year is going to follow suit and start to decline immediately as well.
Okay.
And the 10-year is the benchmark rate that residential mortgages are priced off of.
Okay.
And
So
so,
why doesn't that, tell me a little bit about that connection. Why doesn't that mean that won't go down?
well, because the yield curve is going to have to, I think, uninvert.
Okay.
So presumably you could have the Fed cut rates 3 or 4 times and get to around that 425, 450 mark.
Okay.
And your 10-year treasury might still be at 450. And so that would not be a great scenario for people wanting to refinance their house or, buy at a lower mortgage rate than the 7% today. But that's something to, keep an eye on is depending on how deep we have to eventually cut rates, the 10-year will move. It will come down. I don't think it'll stay, in the mid fours forever. But there will be a time that might be kind of frustrating that short-term rates are coming down and they're coming down kind of quickly, and the 10-year is a little bit more stubborn, and we'll just have to see kind of how that plays out, but something to watch for.
Do you feel any impact from, let's say, the political environment I know there's global elections happening right now, but we're in election season, one coming in November. That's going to be really important. Do you see any of that having any kind of impact on either Fed's decisions or just real estate market in general, or any kind of financial implications there?
I think there will be an impact on yield generally based on who gets elected.
Okay.
I don't think that will be because of the Fed. I think that was just kind of the buyers and sellers of U.S. Treasury notes and bonds are, they're all pretty sophisticated buyers, and they've got models showing, what they expect economic output of the United States to be based on who wins the election. So I think that there will be some swing in yields depending on who wins. What I don't think, and I maybe feel kind of lonely in this opinion sometimes, but I do think that the Fed is actually pretty independent. And
Okay.
I don't think that they feel, they might feel pressure to make, politically motivated decisions. But I think Jerome Powell especially has been, for a long time, really, and he fought with Trump. They sparred really big in like 2019, Trump demanding him to cut rates, and Powell, who's a Republican himself, really held firm and really kept the Fed independent at that time. And I think we're seeing that again, in November, December, when they had their meeting, and then Powell came out and kind of gave his really dovish press conference that caused the markets to think we were going to cut 6 times this year and all that. And like the immediate reaction was, man, the data's not there. This has got to be a politically motivated decision. And, as time has gone on into this year, and they didn't have the support that they thought they were going to get for a rate cut, they haven't cut rates. And so all of the folks who immediately felt that it was such a political decision and probably had to step back and say, well, maybe it wasn't. Maybe it was, they were really trying to be data dependent and stay independent from the political process. And then what they thought was going to happen didn't happen. Because if it was truly a politically motivated Fed, they would have cut rates by now for sure. No president wants to be in this spot right now.
Yeah, I was about to say, for some folks that don't read a lot of economics news, Biden would and the left going into this election as incumbents would prefer that rates be cut so that the economy has a bit of a boost. People feel good going into the election, and they ascribe that feel good to the current administration. Is that inaccurate? Is that why it's politically motivated, that you have this pressure from some senior leaders to go one way or the other with Fed rates in order to impact the economy to favor the elections? But so far, Fed chairman and the Fed board have been pretty stable. And that was a big thing during Volcker's term, during the Reagan's time back in the 70s and 80s. And now it's still seeming to be the case now.
Yeah, absolutely. And it's funny too, because Powell is a huge Volcker fan. And so no surprise that he would, stick to that.
Mm-hmm. Yeah, which economists will say that it is, you don't understand how difficult that must be, the pressure from not only the administration and senior government officials, but also from the population, just general Americans, like, hey, I want to buy a home, I want to buy a car, I want to do things. So yeah, it's enormous pressure.
Yeah, man, you're not kidding.
Yeah. Well, last question. What's something you're hopeful for generally over the next, let's say 30, 60, 90 days, maybe the rest of the year? What's something that you're really looking forward to, as it relates to your job, but maybe even personally too? Just something that, we can leave our listeners with a little bit of hope and excitement about what's coming.
Ooh, okay. Let me think. We'll do both. We'll do job and personal.
Okay, great.
Job wise, we're chiefly excited about launching Silverton Capital. This has been working on for a long time, and we're finally kind of getting to that point of starting to see some of the fruit of all of that table setting come to bear. So that's kind of cool. And then just like we were saying, like some change in the macro market that creates some activity in the multifamily world would be really welcome too. Just, even for clarity, if nothing else, just kind of get a sense of what the next year or two is going to look like. Let's see, personal. Man. Okay, this is a random one, but it would be great to happen over the next 90 days. Like,
Okay.
This is very random. I love the Bible Project, and they've got this part of their platform where you can take classes from there, and I have been taking a class through Bible Project on Genesis 1 for probably a year and a half now. That's how slow. No, not because I'm like diligent and it's like that. Like, it has taken. I just can't ever find it. I would love to finish that class. I would love to. It's been awesome. It's been super neat, and have learned a ton. And it's I don't even know how far along I am, but I feel like 2 years would probably be way too long to have taken this on. So
I don't know. Seminary took me a long time to get through, so I can't say. Yeah.
Yes, I would love to get that done.
Cool. Okay, this is great. What's your this maybe is the last question. I wish we led with this. I'm so curious now. What is your big takeaway from studying Genesis 1 and going through this course? What's been something that's really stuck with you?
Well, where to start? We could probably do another hour on this.
Okay.
Man, my big takeaway, a ton of it has been like really putting Genesis 1 into like the ancient Near East context, and how the culture that the ancient writers of the Old Testament were thinking, and things that we read that we don't understand, that they're actually refuting a different creation story, or kind of clapping back on popular ideas that were out there. That part has been really cool to see. And Genesis 1 gets really bogged down in the whole idea, the whole debate of whether or not it's a literal 7-day creation or figurative. And probably the biggest takeaway that I've had through the whole chapter is like, I think the intention of Genesis 1 is so much more than that. I mean, it is like, it is telling us a lot more than just how or what was created. And it's giving us insight into the whole plan for earth and creation. So that's been really cool.
I love that. Maybe we could have another episode on that if you want to do that in a couple of weeks.
Yeah, man.
There's this one idea that I've heard that maybe because you're going through this, I'll share, but very briefly, it's this idea called placemaking. And when you read Genesis 1 and 2 and 3, of course, but when you read those chapters, you see that the mission of the people was to make this place where God would be pleased to dwell. And then when you read in Revelation, you see that that's the same case, but it's a city, and like that is it's this continuation of this original mission, the cultural mandate to build this city. That was our whole point. And the salvation narrative is like kind of a side quest of that narrative, that we're supposed to be placial people, placemakers. That's what God intended for us, and so we had to be saved in order to be the right kind of people to make the right kind of place. Anyway, it's just fascinating topic. So,
dude,
anyway,
it totally is. I mean, the whole idea of like the, when we talk about the image of God today, we talk about it mostly as like, rightly so, worth, dignity, value, that kind of thing. But back then, it was a role that we were to play. Like we were to do this world initially with God, and we kind of blew that in his presence, but that hasn't gone away. And that trace that thread of God trying to bring us back into that presence, which, like you're saying, culminate in the end of Revelation. That's a fun string to kind of unravel throughout the Bible.
Yeah, and that's what's so cool about economics and finance is that you are literally have these tools that you help create that place. I mean, we are carrying on that mission by using the tools of finance and understanding the world through an economic lens in order to use God's resources and allocate capital in a way that produces the world that he would intend. I mean, that's such a fascinating, cool thing as a financier. So anyway.
Yes, absolutely.
Anyway, I'll talk about that any day. Okay. Patrick, thank you so much for joining us today, being a guest on the ALX show. I'm so glad we got to chat. And, this is one of the few podcasts out there that you get macroeconomic data and talking about Fed chair and politics and the housing market, and then jump right into theology and history and the Bible. So it's a fascinating conversation. So anyway, I'm grateful for you. And I would love to, continue that chat and keep talking through it.
Man, absolutely. Absolutely. Always fun, Brandon.
Cool. All right, man. We will catch you next time. We'll see you.
Sounds good.